also the rupee. The third and final question, let's handle the macro first, then we'll come down to what is Quant AMC doing. Mr. Tandon, your view on this very negative stance that foreign institutional investors have taken on India. March was very painful. For the last 7-8 months, we've seen consistently very high selling number. So what is your view on FIIs, and because you track sentiment so well, is the AI trade over in Wall Street, Japan, Taipei as well as Seoul?
Okay. So I will put it in a very simple manner. See, we have to understand returns are not always absolute numbers. It's a relative also. When you look at returns, we look at returns from absolute numbers and relative numbers. Now look from FI perspective, the relative absolute number was not bad. Our absolute performance India was not that bad as people think, but the relative performance was horribly bad. Okay, so what we have to look at, when foreigner has option to invest in other country where they are able to capitalize this AI boom or so-called new energy, new tech companies, which is performing very well globally. Unfortunately, we lack in that space. So obviously, sentiment from the FI perspective is bound to be negative, and it's not like FIs are saying that, it's reflected in their actions, and that's the reason people are panicking. But I always say, you have to look at not just a contrarian, but more from a data perspective. Now, I'll give you a small example. When in 2024, when we turned negative in March, or between March and July 2024, best of the houses was coming out upgrading India. Okay. Now, if you look at with January to now, majority of the houses has already downgraded India. Okay, so it's a very classic sign. Exactly at the peak of bottoming cycle is when nearby people give up. Best of the brains also give up.
Yes.
So this is the way we strongly feel these inflection points are there, and it's up to us how you want to read that. We are reading in a more constructive background because we don't try to bring any biases into it. Okay, and that's the reason I'm saying that this is the opportunity. Now, if we have to talk about from other market like AI trade perspective, at least from a data point of view, I can tell you that Korea is giving extremely good sign of a topping out. Okay, I'm not talking about a long term or bubble sort of formation, but we have seen a euphoria in Korea, and something similarly is there in Taiwan also. I think first Korea market has potential to peak out, followed by Taiwan, and something similar I expect even US has potential to correct and consolidate. I'm not expecting a crash or a sell-off happening, but I see there also good amount of correction and consolidation can take place. If that happens and these market performs relatively, let's say, generate negative returns, I think that will be a great news for India, because we want these market to fall, then only money will shift towards market. So it will be very constructive background to say if these market corrects, we should be beneficiary. Generally don't happen, but this time it should happen.
Absolutely, and that's the reason, Mr. Tandon, why your advice matters so much. You are a master at reading the turning points, both at the peak as well as the bottom. And yes, we've had a series of downgrades by many institutional brokers on India. Perhaps this is the time to step into the market on the long side. Now, what has Quant AMC been doing over the last 1 month or so? How have you treated your cash positions? Are you still majorly in cash above 10%, or is this a time where you've invested very heavily?
So right from April, when we made a call in public forum, in our fact sheet also we have written about it, that we are constructive. Obviously, if we are giving advice to others, first we have to implement it our end also. So we are largely invested. So except maybe 1 or 2 scheme where we need to keep some cash, like small cap. Otherwise, we are 98-99% invested in the market at this point of time. So obviously, that's purely on our data analytics strength, which we are talking about. Now, as a house, we have played this data center theme, because in India, you cannot play any of a AI theme. So data center was the only theme. So whether related to power sector or telecom company or fiber optic companies, or we're talking about select equipment companies, we have played that cycle quite well, and we have been one of the biggest beneficiary, because we were significantly overweight nearly 30% of other data center theme in our portfolio. That has really helped us. And given the challenges on the rupee as well as crude front and the uncertainty which we have seen in last few months or so, we have cut down our manufacturing exposure, and it is not possible to cut down completely, but we are more skewed towards services and other product company rather than getting into pure manufacturing where we are not sure about the input challenges or the distribution challenges. So we are very, I will not say extremely cautious, but we are on a relative basis, we felt this is the time to be underweight manufacturing and look for other opportunity, which also has helped us in last few months in terms of our performance. That's the reason we have done extremely well in last 3 months.
Okay, wonderful. Now, let me just get one issue out of the way. Last time we spoke, you were intensely overweight on two stocks, Reliance Industries and Reliance Geofinance. Somehow they find a lot less mention in the current AMC's holding structure. What exactly did not go right for both these stocks?
So first of all, Salary, you understand we don't really from a compliance perspective, we're not supposed to talk on the stock specific. Okay. The only thing I will comment, see, we are some of the large cap exposure which we held in our portfolio was largely from a risk off environment, and a risk off environment I like to own low beta and high liquid names in our portfolio. As market cycle changed toward high beta and extreme negativity which we have seen, it makes sense to cut down large cap exposure and increase your mid and small cap exposure. This is exactly what we did in last few months. So maybe the realignment of portfolio keeps on happening in a very dynamic manner. And we always say in risk on environment, our portfolio will be very different, and risk of environment portfolio construct will be very different. So it's our call which we take. Since we are a very dynamic house, we actively rebalance our portfolio based on the environment which is prevailing.
Okay, fair point. Now, as an AMC, where are you overweight as far as the first 2 or 3 positions are concerned, sector-wise, or maybe even a large cap or mid cap bias?
So obviously the bias is definitely small and mid and even micro, but unfortunately as a AMC we cannot participate in many micro name purely of the liquidity perspective. But our bias is definitely towards mid and small. But given the size we operate, it's not possible to have a very skewed portfolio towards mid and small, because overall liquidity in this space is on the lower side. Purely from a risk perspective, you can't do that, even we like it a lot from the current level. So what we have done, we also have the rebalance of the portfolio and we have skewed our portfolio towards power, telecom, pharmaceutical, services sector, and up to small extent some of the unique companies also. So very skewed portfolio we have been running. We are more skewed toward NBFC, some insurance company, instead of running a very large banking exposure, which majority of the houses are doing right now, given the large weightage of tech. So we are relatively less exposure. In fact, we have second line banks in our portfolio as compared to large cap banks in our portfolio, which has also helped us some of our schemes in a big way.
Absolutely. But there are very few large cap banks, and it's worked very well for the overall positioning of the portfolio. Mr. Tandon, a very heavy emphasis is on telecom, especially telecom infrastructure. Is this the domestic theme that you are batting on, given that it has absolutely no correlation to the West Asian crisis? Telecom finds a very strong mention.
See, two things. One, from a manufacturing background, if we are in a challenging times, okay, nobody cuts down their telecom budgets or their bills. You've seen it will be rising a bit. And given the entire focus on AI thesis which is getting built, the telecom weightages or exposure will only increase in our portfolio or in the multiple broader indices. So that's a background. We think purely from a return perspective, yes, but even from a risk perspective, we see limited downside in some of these names, and they are, most of them are fairly liquid names also. So it fits the bill on multiple front, and that's the reason we have relatively high exposure in the telecom basket in our overall portfolio.
Okay. I think one of the biggest questions that are facing the markets is two mega IPOs, NSE as well as Reliance Jio, should be hitting the markets before Diwali. How is Quant AMC's research team looking at both these IPOs? Any chances for them to be maybe slightly overpriced, or how do you see them?
They have just filed their IPO and their HP has just filed. I don't think our team has looked into it because too premature to talk about. But as and when it unfolds, we are closer to the issue. We obviously, as a research house, will evaluate and take appropriate decision at that stage. Yes, no doubt. They are one of the largest IPOs coming in the country. So it is very natural that majority of the global houses, including domestic mutual fund, will be participating in these two names. So I'm looking forward because a good development that the breadth and the capital market is also going to improve significantly because very large IPO will get listed. It's a good development from Indian capital market perspective also.
Okay. One issue that is being grappled by capital markets at this point of time, Mr. Tandon, is the deep value that the IT sector offers. I see from the AMC fact sheet that you've been shopping very heavily, at least on one large cap IT. Do you see this as a value opportunity, the erosion that we've seen on large cap IT, or is this still a value trap?
So the way I look at it is that right from September 2021, we have been quite bearish on this space, and actually it worked in our portfolio. Maybe till March end, the entire IT weightage was hardly anything. The nearly zilch in the most of the large cap companies, except one or two smaller names, and that too the product company which we had in our portfolio. But given the background we're talking about inflection point, we think most of the IT names, large cap IT names particularly, are now trading in the most hated and neglected zone. Okay. Now the hated zone or neglected zone alone is not good enough to showcase that we should go all out. The only thing we can say, yes, is a good time to good amount of bottom fishing, and then you have to look at what could be the trigger which can change from these levels. So purely from a behavior perspective, maybe early signs of bottoming character is visible, but it is too premature to take a very aggressive bet and saying that I'm going all in at this level, because the industry dynamics have changed significantly, and we have to understand how many companies can actually be a really AI implementer. Though everybody talks about, everybody take claims about it, but frankly speaking, last many years, not much has happened in this space, and that's the reason not only the IT space, India overall has been downgraded globally because we didn't have this opportunity as our entrepreneur. This is the biggest miss from our perspective.
Okay. Mr. Tandon, do you view the fact that for the last 18 months or so, India has really fallen off the investment radar? In fact, it's been used as a piggy bank to pull out money from India and then pour it into many other emerging markets, as also Wall Street. Do you see this trend a larger question mark on the way the economy has worked, in the sense that we don't see any growth engines at all?
So the way I look at, we all go through various phases. Let's talk about from a market perspective. After 2008, not only India, globally, people are running like a quasi-passive strategy. In the name of active management, people were offering quasi-passive product. But if you really look at in last 8 to 12 months or 16 quarters, what we have seen, whoever has taken running a very skewed strategy globally, okay, not only India, globally running a very skewed strategy has been biggest beneficiary, okay. And this is the herd mentality when few AMC or few money manager become successful globally by looking at the new trend, people tend to chase that strategy. Okay. And that's the phase we are in right now. From quasi passive, we are moving toward very skewed strategy, and that also has its own challenges. Okay. Now, early stages, this thesis will work very well. The way I am looking at right now, if I compare India versus Korea or Taiwan or even China, Hong Kong market, yes, we lack that opportunity, but you have to look at India as a very well diversified portfolio which we offer. It's not about two companies like Taiwan or few
Mhm.
companies in Korea or select companies in China. So it's not the case. We have entrepreneurship is clearly visible. The holding, which really 50% holding we have in most of the entrepreneurs holding these companies. So I think India offers far better diversified and far bigger opportunity from a medium and longer term perspective. Short term, obviously, we had our own challenges, but look at the scale we operate in our steel or ports, or you talk
Mhm.
about airport, which is new building blocks
Mhm.
now. Talking about power sector, which is getting particularly in the renewable space, we're
Mhm.
going to be a sizable player in next 4 to 6 years. So I think foreigners are now looking at India also as a asset heavy companies who generally have very large infrastructure and has ability to generate free cash flow. Those are the companies people are looking at. So it's not be fair to say that FI has been completely ignoring what we have not understood. They have been selling
Mhm.
grossly over owned stocks like banking, IT, and up to small extent consumption, because these are the only names which they had in their portfolio. So they will
Mhm.
like to book profit for relative
Yes.
opportunity perspective, but they also has been buyer in some of these names. So it's not fair to say that FI has been net seller,
Mhm.
yes, but on select opportunity, they are shifting the exposure from one company to other or one sector to other. So I think that's a trend which we have to identify. That's the reason we are also very bullish on large infrastructure companies like which a company which own airports, ports, renewable power, okay, or an allied industry. So I think that's an area which we think India will do very well. And I have seen capital is coming back. I'm saying foreign capital, FEI flow is coming back to these spaces. So one has to be very selective, and I can say that second half of to or maybe from second quarter we are talking about this. One should not look at broader indices in any manner. Just focus on stock specific opportunity. You will make good amount of returns and maybe superior risk adjusted return, because not much will happen in the broader indices, and hence quasi passive strategy India will also not going to work very well, which has been the trend in the past. So I think you have to look for an active money manager who can generate alpha for you, what the trend we have seen in last few quarters in the global markets.
Okay. When you talk about the stock specific strategy, Mr. Tandon, uh, let's take the broader picture of the entire AMC portfolio. Where would outliers be in the AMC overall AMC portfolio? Maybe first 10, maybe the next 20. Where do you see market beating returns within the quant AMC portfolio?
So, Shalini, the way we've explained it, it keeps on changing from time to time. So, it's not be very static phenomena. We always say we live in a very dynamic world, and our money management style cannot be very static. So, from that perspective, we believe in a dynamic rebalancing of portfolio. So, today, as I said, these are the area when we talk about large infra or large power company or data center companies, we are skewed our portfolio towards telecom or power or some of the services sector. But that may not necessary, because they are getting offering us superior risk adjusted opportunities. So they are part of our portfolio. Maybe down the line, 3 months, 6 months, if something else looks more attractive, we don't have any hesitation in shifting or rotating our
Yes.
portfolio from these names to that. So it will be not fair to quantify what is there. Whatever is there is publicly disclosed. We are first to disclose our fact sheet. So you get those data, and we are first to disclose our portfolio also. So that you can figure it out. But what is more important from a retail investor is not about what stock or what sector we like. What people have to understand purely from a risk perspective, from a timing perspective, it is a good time to rebuild your exposure in the market. That's point one. Second thing is the time to rebuild your small and mid cap portfolio also on your portfolio. And third, to remove negativity which is there in your deep subconscious mind and come back with a constructive mindset, then you will generate superior alpha.
Okay, now let's look at the quant small cap fund. This is of course your largest offering. 31,000 crores is what you manage at the quant small cap fund, and of course it's been a quality provider of very strong returns over the last so many years. So you are underweight financials as compared to the sector, and extremely overweight when it comes to energy and the utility space. What attracts you to the energy and the utility space as far as the quant small cap portfolio is concerned?
See, when we look at portfolio, we don't look at a scheme specific portfolio. The differentiated part of quant, all the scheme is managed by one team, okay, like in other AMC, individual money manager manages schemes. So one manager could have a very constructive view on utility, other money manager could have equally negative view on the utility. That's not the way we operate, okay. We take house call, and house call is based on the data which we work, and data analytic team is common across all the scheme. And that's the reason we look at various schemes more from a SID perspective, from the allocation perspective, not from a scheme perspective. If we think a utility as a theme or power sector as a theme will generate superior alpha for our investor, that is our moral duty, or rather fiduciary duty, to ensure that every schemes get proper allocation. Since most of these names are very large cap and mid caps in portfolio, so obviously in small cap their weightage is on the lower side as compared to large cap. Okay, but whatever best we could have added, we have added in our portfolio. That's a way the portfolio construct will always. If we like something, let's say in telecom basket or in the fiber optic space or some of the data center companies which are largely small cap, that's the reason some of these names, if you see your portfolio, will be more skewed toward these company, and where large cap and the semi large cap company will not have those names in our portfolio. It's purely depending on the what type of exposure. Since we have a compulsion to maintain 65% small cap exposure, by default this exposure is on a significantly higher side. Sometimes people think is that we run a very skewed portfolio. Answer is yes, we run a skewed portfolio, but these are very data driven calls of conviction which we run the portfolio. I'm not a great believer of extraordinary diversified portfolio. Mathematically, diversification tends to reduce your risk, but extraordinary diversification also creates more problem for you rather than actually in any help.
Absolutely. One question on the mid cap portfolio. The largest holding is still cash.
No, I don't think so. It's cash. In fact, it's hardly 3% or something. It's not. Like, maybe you are not looking at the derivative side of the portfolio. Okay, you are looking at the pure cash portfolio. When you look at our portfolio, you should also look at the exposure in the derivatives segment also, which enhance, we can say with some amount of confidence that we are 98, 99% invested in the overall market. When it's small, obviously, we keep some exposure because they are not very liquid names. So whenever you get opportunity, you should have cash. That's the reason we keep cash. Because flipping in large cap is relatively easy as compared to mid and small. So the cash level by default as a strategy will be always higher in the small and mid cap centric fund schemes which we manage.
Fair point. My final question, Mr. Tandon, is on the RBI steps on this FCNR fixed deposit that it's offered to PIOs and NRIs. What, according to you, is the corpus we should expect over the next 3 months or so that might help our foreign exchange reserves on its way up?
I expect at least somewhere 50 to 70 billion dollars can come to this space. But given the it's what is important, the pace. If it happen in first 3 months is very good for the rupee. If it has happened over 9 months, then I will not look at the very great news from that perspective. But I think extraordinary money is also not required. It should not happen that we take away very sizable money, okay, and then you run a much bigger risk at later stage. But I think closer to 50, 70, I think 50 billion is also a good mark number where government should put a full stop. That is the maximum they want to look at. I'm sure they could have worked their own numbers, but I'm a believer at least $50 billion will come.
Okay, and my final question, Mr. Tandon, are we looking at a better Diwali than a bad monsoon?
Yes. Okay. In fact, beginning January, you said by end of this year, you will see all-time high again. So, and something similar I said in 2025 also. By December 2025, you look far superior than what you're looking at January 2025. So, something similar. I will not be surprised if you see market making all-time high maybe in November itself. So, I think, but what is important, I said, the levels of the indices is not important this year. The stock selection and its skewness and concentrated portfolio will be a better strategy than running a very diversified thing, because if you mimic indices, an index will not going to go anywhere. You will not generate that desired alpha which investor expects.
Mr. Tandon, even if we hit an all-time high on the market, many people would be very happy with that outcome. Of course, you are a past master at picking outperformers and selling them before they peak, as also buying them around their bottom. So, of course, for your own self, you are looking at that very high benchmark, but for the broader markets, we are very happy to see a record high. Thank you. What a lovely conversation. We hope to meet soon. And here's wishing you all the best for the greatest returns on Quant AMC. Thank you for your time.
Thanks for inviting us.
That, ladies and gentlemen, was Mr. Sandeep Tandon, founder and CIO at Quant Mutual Funds. Lots of positives to take away. Broadly, he's bullish on the market, sees the worst behind as far as the rupee is concerned, sees the broader markets to be sector specific, stock specific, rather than a broad rally on the index, and has a bias towards mids and smalls. Of course, hopes that Diwali will be better than the dismal June and May and April that we've seen, and sees the market making an all-time high in November.
The National Stock Exchange is in the headlines, and it's in the headlines not just because of the fact that the markets and stocks are moving, as we all know, moving in a certain direction on account of certain worries around our IT stocks. But today, what we are going to do is to get into the National Stock Exchange and its own IPO, initial public offering, which is expected to be India's largest so far at 30,000 crore rupees. And this has been a long story, a long saga. It's seen many twists and turns. And today, me and my colleague Shailendra Bhatnagar are going to discuss the turnaround and the man behind this turnaround, Ashish Kumar Chauhan. Shail, welcome to this chat. The numbers and why this IPO is important for our markets and in the journey of India's markets to where they have reached and where they are expected to eventually go. You've also written a story. Please do go and read that story on businesstoday.in. But Shail, before we get into the facts and the market details, I want to start this chat with an observation which I don't know how many of our viewers know about. I can't easily recall of any other executive professional who has done as many listings in the financial space that Ashish Kumar Chauhan has done. Business promoters, family businesses may have done many more listings, but this is a pretty unique instance. Ashish Kumar Chauhan, who joined the National Stock Exchange 4 years ago in July 2022, will now, once NSE lists, have a fifth company that he has taken public. And before that, if you are wondering, those companies, the Bombay Stock Exchange, followed by CDSL, followed by Protean Technologies and NSDL. So 2 in BSC, 2 so far in NSC, and now the mothership also being listed. Shell, what does it kind of tell you? How unique or significant is this?
Siddharth, firstly, thank you for having me over. And this is uniquely Mr. Chauhan. I don't know whether I should start with this example or not, but just today our research team was looking at 5-year performance of multi-baggers, and Siddharth, which was the first one, it's the Bombay Stock Exchange. You will not be able to believe what I'm about to tell you. The Bombay Stock Exchange, ever since its listing, has given a return of 125 times in the last 5 years. It was, of course, listed in the middle of the previous decade, but all of his listings, whether it's
are you setting a
CDSL,
similar expectation for NSE as well, Shell?
Well, not really, Siddharth, but definitely this is a multi-bagger stock to be listed, because you see, at 5 lakh crore rupees as your initial pop, to get it into 125 times would be, beating SpaceX at its own game. But remember, BSC started as a small cap, it is now a large cap, and I am sure Mr. Chauhan's magic will work. Similarly, CDSL is a multi-bagger many times over. I am making a very educated guess, at least 20 times is what people have made money from the IPO till today, and this is a corrected price on CDSL. NSDL and Protean are recent listings, but they've also done phenomenally well, Siddharth. So the man with the magic and golden touch is now helming NSE, and he joined at a time when NSE was actually going through his worst phase when it came to corporate governance and many other issues that were surrounding the event, surrounding the exchange because of regulatory and other problems, all of which we know in great detail. Siddharth.
The comeback story of the National Stock Exchange from a listing point of view, viewers, because I would really encourage you to even check this link and the description. In that we have a small gist of what Shell has written about the internals of NSE's finances, but do check out that whole story on our website as well. But it's a very complicated comeback story, because somewhere this iconic institution that changed the way Indians trade, that introduced technology way back before it was known, and today I would say the National Stock Exchange, with the kind of expenditure it has on technology, I don't know how many of you know, in FY26 alone this company spent over 1300 crore rupees only on the technology function, and many people feel and describe it more as a technology company than just a stock exchange. So for this kind of company that was set up and represented the approach towards liberalization, opening up the economy, changing the way India does business and approaches business way back, all of that had come under a cloud because of the mismanagement, the mistakes, and there's a bunch of allegations out there which we need not go, but that eventually also ended up among other things being called the co-location scam. And Shell, that's been a very difficult, tedious journey for Ashish Kumar Chauhan to navigate, and he's pretty much spent the last 4 years of his life, he's 59 today, navigating that. How big a deal do you think was the repair of the relationship with the regulator in terms of where we stand today post the DRHP filing?
Siddharth, it was a very, very critical component when Mr. Chauhan helmed NSE. His mandate was to clean up and get this IPO up and running so that you have a global name when it comes to, pension funds, sovereign funds, and many other deep pocketed FIIs wanting to invest in India's financialization process. And it could not have happened unless you had clarity on what was the contingent liability on the NSE as far as the co-location issue is concerned. Now, SEBI, in its wisdom, and of course NSE in its practical outlook, went forward to look for a settlement, and all that is now in place in the last 4 or 5 years. Siddharth, I cannot even begin to emphasize the importance of this listing for not only Indian capital markets but for the broader economy, as also once in a decade kind of a situation happens. You and I have covered the listing of Bharti Airtel in February 2001, Maruti in 2004, TCS in 2004 August, so many other companies in the latter part of the previous decade. So this is, I am telling you, the biggest event that you can think of in the calendar of a decade as far as India's economic journey is concerned. It is difficult to get bigger than this.
Absolutely. And I once again come back to this point, viewers, those of you who have more than just a cursory interest in the stock markets, know that moving away from that antiquated, non-transparent legacy system of the stock exchange to a modern, technology-driven operation where time is counted in nanoseconds and not even in full seconds is a very, very important story of India's IT prowess also. And Ashish Chauhan's foundational years have also been spent purely in that, not just as a leader of the institution, now taking the whole institution forward, but also from a tech stack and building it as a technology company and as a technology startup. So that's very, very significant. Coming back to the point that you were making, Shell, 1995, fully computerized, screen-based electronic trading platforms. I wonder if you can recall how many countries in the world would have had such a computerized system for share trading way back then?
Siddharth, I'll answer this in two parts. Even till now, the New York Stock Exchange till about 5 years ago used to have an open outcry system in on Wall Street. And in 1995, Siddharth, I am from the generation who went into the Bombay Stock Exchange ring to trade. This white shirt used to get dotted with pens because people used to hit you to buy Tisco, Telco, Reliance, SBI, Old World, Mafatlal, Nosil, so on and so forth. It was a painful process, and 90% of transactions of the Bombay Stock Exchange emanated from the city of Bombay, now Mumbai. With the advent of the automated NEET system, the entire country joined. There is something.
So that's the national. The national stock exchange is actually national.
Absolutely. And Siddharth, it is really, really big. NSE started the 7-day settlement. On the Bombay Stock Exchange, the settlements would vary between 15 days to 3 months. There was no guarantee whether you would get your share that you had purchased or the share that you had sold on money at a given time. The beauty of NSE was the setting up of the Settlement Guarantee Fund, which ensured that any nameless, faceless investor who had an account with the NSE would definitely get either the money that he had sold shares for or the shares which were purchased by him. It did not matter if the opposing broker would default. It was the NSE's responsibility, Siddharth, to deliver either the money or the share. It was a game changer, believe me, from the legacy and the antiquated systems that regional exchanges offered at that point of time.
Let's also listen into Ashish Kumar Chauhan from our previous multiple conversations. Here's a slice from that in the past, just to give you a sense. And of course, we are going to reconnect with him. There is an entire process of media interactions, public commentary that comes into play after a DRHP, and you have to follow a regulatory process. But just a slice from the past on some of these points that Shell and I have been discussing, and then we continue this conversation.
India is in a unique position. We have now 12.7 crore investors being serviced through NSE, which is literally more than 30% of all households in India. And 99.85% of all PIN codes, almost I think 28 PIN codes don't have NSE investor today. If you go to Ladakh, we have investors. If you go to Andaman, Nicobar, I think the guys moving with the spears also have a demat account and are having mobile app of our brokers. And similarly from Dwarka to Arunachal Pradesh, we have investors who are investing into India's future, right, in the productive capital. Also the technology. India is also the youngest nation. It's the demographics which makes a lot of difference. The China grew from 1982 to almost 2015 on the back of a population which was building up. Today, they are suddenly going down. And in 2024, they had less number of people than 23. In next 70 years, they will become half the size today. That is true with Korea. In next 40 years, they will become half the size of the population today. India is going to grow even further. And that's where I'm going to remain young for very long.
Shell, as we wind down this conversation, let's also look at the broader picture, because we've kind of made it clear that how important this listing is. And as you are pointing out, it's going to be amongst the in fact, the 10th largest stock by market cap, if it's valued at 5 lakh crore, even ahead of another iconic stock like Infosys, for example. And it will clearly be a milestone. 2 points to that question. The approach of retail investors. We are not offering stock advice, viewers. Be very clear on that. That's not our job. But in the current environment that we are seeing in the markets, the element of risk and the element of opportunity, what is in it for retail investors as far as this issue is concerned?
Siddharth, if you don't have the National Stock Exchange in your long-term wealth generating portfolio, which will be a generational purchase, I think you are missing the boat. See, in India, only a small percentage of people are in the world of finance, barely 7, 8, 9%. This is compared with 33, 34% in the US, if not 50%. So this pie is going to expand. Now, there will be no new exchanges coming up in India. You have 4, which is BSE, NSE, MCX and IEX. So this is a monopoly item with at least a 90% market share in cash and about a 50-60% share in futures, an absurd 90% share in options. So you are going to miss a monopoly which is priced very reasonably. 40 PE versus the 70 PE of BSE. So if you don't have this in your portfolio, you are going to make a mistake. Please consult a financial advisor rather than listening to me, and hold this stock for 15, 20, 30, 40, 50 years. Siddharth, it's a once in a lifetime opportunity. Remember, LIC is the biggest shareholder of NSE. It is not selling a single share. It knows it has a golden goose.
Well, you speak about a golden goose, and really the saga that started in 2015. Remember, this is a company that was founded in 1992. Trading commenced in 1995, but in 2015 and there forward, the last 10-11 years have been a mixed bag. But in the 4 years that Ashish Chauhan has been at the helm of this company, he's now set it up for a next phase. But Shell, if the stock market regulator finally, after a change in guard there as well, and we must note here that Mr. Tuhin Kant Pandey has reformed even many aspects of SEBI as well, and we could well say that letting this move ahead and settling the matter and the settlement offer that is there, all of those technicalities we are not getting into, even that is movement forward. So in some ways, SEBI has told the National Stock Exchange कि जियो और आगे बढ़ो, काम करो. But the other big DRHP that's also been filed, and this is now going to be a question for institutional as well as retail investors, Shell, is who do you pick? Is it the NSE or will it be Jio? How should the average Joe on the street approach both NSE and the Jio offer with all that is now behind it and as is promised?
So, Siddharth, I will answer this question in two parts. I am sure the investment bankers of both these mega IPOs will be common to some extent, and they will very, very sensibly and practically sequence these IPOs to come after a gap of maybe 10, 15, 20, 30 days.
So not going head to head.
You and I have covered telecom, and no, they will not go head to head. It doesn't happen that way in Dalal Street. And as you would know definitely that the back end IT infrastructure of India's largest company by market capitalization was also set up by Mr. Ashish Chauhan.
Absolutely. And viewers, that's also so I don't think it's by design, Shell. It's clearly something that has happened, and it's happened because this is going to be a seminal week, because the Jio document being filed today, the NSE document already filed. So when we look back at stock market history and pivotal milestone moments, days and weeks, this week of June 2026 will certainly be very, very significant. So wrap it up for us. What more can we tell our viewers at this stage about the details of the Jio offering?
So Siddharth, abhi nothing is finalized except for the fact that there is a DRHP in the offing, and of course it will also be a follow-on. It will also be a FPO, because several of the investors who got in during the COVID crisis will want to sort of in cash on the booty. We can, because you and I have covered telecom, we can keep Bharti Airtel, India's second largest provider of mobile and telephony services, as the base for Jio. Jio will be priced in sync with Bharti, if not higher, because Jio is a bigger player. So the kind of wealth creation that we have seen in Bharti over the last 25 years, Siddharth, Bharti was listed in February 2002. It came at 45 rupees, got listed at 42, fell all the way to 19. You and I have covered that journey as well. From 19 to 1800, this is a 1:1 bonus, so the price is actually 3600. So from the journey of 19 to 3600 is what Bharti has traversed in the last 25 years, when all sorts of uncertainty was there in telecom. From now on, you have a duopoly, which is Reliance Jio and Bharti Airtel. Therefore, these are must-haves in your portfolio. In a country of 140 crore people who are consuming data like nobody's business, it's a no-brainer, Siddharth. The maximum money in the market is made when you have uncertain times. We are completely in that uncertain phase, and two opportunities have come or will be coming, NSE and Jio. People who will miss them will remember for a lifetime what a wonderful party they missed.
Absolutely. And for professional, amateur investors, traders, I always end any market related conversation with the appeal and request.
Yes.
Please only follow proper registered advisors. Don't listen to tip-bazi. Go to established credible platforms, people who know their business, because it's your money. Don't trade it, don't spend it, and don't fall for a call center scam or for some fake arrest or any of those scams where you get to read and hear every other day that crores have been lost due to such mistakes. Markets are serious business. It's about investment and following the details. And therefore, in a week where a very, very significant development as far as India's capital markets and public issues are concerned has taken place, it's all the more important to be cautious, reasonable, and certain about your approach towards the market. Shell, thank you very much. And once again, a wrap on this conversation. We'll see you again. Until then, goodbye.
Welcome, you're watching BTTV. This is Astha Chopra, and today we are at S&P Global Energy event. For more information, we have a very special guest with us, Mr. Premashish Das, who is the Executive Director of S&P Global and heads the research and analysis of oil markets. Thank you so much, Mr. Das, for speaking to us. We saw your keynote and it was very amazing. Let's start with a very basic question about the oil markets as well. So are the oil markets today more resilient to the geopolitical tensions which are happening, or is it like stable as always?
I think, if I think back maybe 20 years back, I think from that point, I think the market is more resilient for basically two reasons. One part is there are more supply was already there. If you recall, like before this war happened, we were talking about a market like there's a significant surplus of oil. Essentially, that was the kind of situation we were because of more supply was there. And also another factor is that demand growth has been slowing down, particularly for the key refined products like gasoline, diesel. So with all that actually, so if I look into that market as such, I think market has more shock absorbing capability now compared to maybe 20 years down the road. And one of the key difference I would say is the US situation. US used to be an importer, now they're a huge exporter of energy. So in the meantime, I think China, India, their demand has increased, their requirement have increased, but I think still I think overall I think the balance looks to be a lot easier compared to that time. So I think yes, if I look into pure fundamentals, particularly coming to this part of this session, this part of this disruption, I think we are in a better position, and that is the reason I think some of the shocks which could have been much worse, we did not experience that.
Absolutely. So one thing I want to understand, there was a lot of tension if you talk about only India. There was fear of being locked down. What do you think that India will face a double inflation if the oil prices spark more in coming days?
Yeah, first thing is so far the developments are kind of favorable in that sense. So if this MOU which has been signed, so hopefully if next 60 days that discussion, if that is successful, I think chances of high oil price will be a lot less than otherwise. So from that angle, I guess India may not see that high price, but yes, always there is a possibility, because here we are talking of a two countries who have been in kind of fight, or at least mentally fighting each other for
Absolutely.
almost 50 years.
Yeah, it's unpredictable.
Yeah, so we don't know like how these discussions will take shape, but yeah, I mean that is what. I mean, if that thing really breaks down, actually, I mean, there could be a possibility that price can go up very high, and more so because I think first half of the last 3.5 months, actually, the world has consumed a lot of the buffers already. Means if there is a breakdown happens right now, I think the amount of buffer left is much less. So possibility of a spike on oil price could be a lot more.
That's true. That's true. That was my second question. According to the data, of course. So, what is the bigger risk to oil markets right now? Is it the geopolitical tensions or like slowing the global economy growth? What is it?
I think the bigger challenge in my mind is still geopolitics. I think the clarity has to be there, like what is happening. I mean, I think inflation definitely is a consideration. I was reading like yesterday, I think the Fed discussion, they are now talking about increase of interest rate versus reduction. We are talking about reduction at the start of the year. Now they are talking of if the interest rate is increasing, essentially that means that they are feeling the inflationary pressure there too. So that is definitely not a good sign. Like when the interest rates are high, that means challenges for the economies will be a lot more. So I think, but again, both of the things are kind of related. Like because of the economic, the geopolitical developments, I think economic activity could be impacted, like what has happened in last 3 months. Like it is a pure geopolitical driven kind of drawdown in the so-called economic activities demand. So yeah, I mean they are related. But geopolitics is always top of the thing because that can drive a lot of stuff. I mean, which is outside a lot of people's control.
And what do you think about the OPEC's influence on oil?
I think, I mean, if this right now, obviously, OPEC has very limited capability to do anything because of the Strait of Hormuz is closed, right?
Yeah.
So once the Strait of Hormuz is open, I think then OPEC's action will be important. I think OPEC was kind of showing the intent to increase their production. So that is, if they continue that, of course, that is going to help on the short term. But on a longer term, actually, that could be a challenge for OPEC as well, because now UAE is outside the OPEC umbrella. So if UAE is increasing production and all others increasing production, so at some point of time, OPEC has to see like how the price impact versus how they want to kind of balance the market. So, but again, having said that, I mean, if I look into our balances, I don't see that that is coming anytime like next 6 to 12 months. I think the market will be still tight. I mean, we think, and so with that, I think OPEC definitely will try to increase production, which will be helpful for the market.
So what if the barrel turns again at $100 per barrel? So what will be the consequences? Like, should we be ready for that, or it's like, are we seeing an ease on that?
No, I think I mean, as a country, I think India is a huge importer of crude oil, right? So from that angle, like if the oil price is high, that means there's a huge drawdown on our essentially in terms of the foreign reserves and the economy itself. Actually, inflation could be much higher. So high oil price is always a challenge, and although as I'm saying, like there is a bit of positivity right now because of all these deals and signing, but I think we should be prepared always. There could be a challenge that the price could be at higher level, and so that means essentially obviously government cannot, I think in my mind, will continuously kind of shield the consumers. So at some extent, government has to kind of pass that some of the cost to the consumers, and that could be a challenge for the consumers, as you can think of. Like it is essentially could be inflationary, could be challenging, but if there is a high oil price, I don't think anything else can be done, because we are not a huge producers. India is not a huge producer of oil. So, and we are dependent significantly, 90% of our crude is imported. So we have limited control. Only thing, but from this disruption, I think one thing we learned, I guess, is essentially how to perhaps what are the things we need to do differently to at least there are two shocks typically. Generally, one is price shock, another is volume shock actually. So I think the volume part we can control, price part we cannot control possibly. But the volumes part, I think we can plan properly, essentially, particularly the inventories, how we want to manage inventory, how we want to diversify our feedstock or crude sources, how we want to kind of set up our operating companies like trading, how we want to be involved in the trading activities, how we kind of look into our refineries and kind of do some, increase their flexibility so that they can process different type of crudes. All those things in our hand actually in a way. So I think we should do what we can do and focus on that. But price part is pretty much international. You never know what can happen, which is definitely not India's control.
Absolutely, we have to work on the solutions and just pray that this unpredictability ends soon. That's the only thing we can do right now. But yeah, you gave us a very clear picture of what's going to happen and what will be the consequences vice versa. Thank you so much, Mr. Das, for speaking to us. It was a pleasure to have you on our channel. Thank you so much. Thank you.
Thank you. Thank you.
On ground in Bengaluru, joining me is Anish Raman, who's Chief Economic Opportunity Officer at LinkedIn. Anish, thank you for joining us and congratulations on your book, Open to Work.
Thank you.
Let me begin by asking you, how relevant is the phrase open to work in today's age of AI?
I would say highly relevant because we've got it on the cover. But the story of open to work, I think, is really interesting. It is a filter on LinkedIn that you can put if you're looking for work. We launched it during the pandemic when suddenly people all over the world were out of work overnight. And it has really helped people find work. And the best part to me is you can do it privately to recruiters and it helps you. But the people that do it publicly and are able to get their community to help them through weak ties. I know this person, you don't know them, you should talk to them. So it started as just open to work, looking for a job. But in the age of AI, we think it's so important for all of us to be open to. And open to how work is changing and what work is changing into.
Great. In today's times, we've moved on from an era of, say, credentials or degrees to that of skills and creativity and how many apps you can work on, which also, of course, comes with the AI. How do you see the current scenario with hiring, especially by white-collar companies and jobs across?
Yeah, I mean, right now it's tough if you're looking for a job. It's gotten harder to get an interview because the AI tools make it easier for people to apply to jobs. The volume of applicants makes it harder for recruiters to sift through. So right now I would say AI is making it harder to get hired and harder to hire. I think that will get figured out and we'll start to get to where people are more intentional about the jobs they're applying for or the interviews that they're going for. Employers have always had a hard time shifting even to skills. I mean, India's in the front. It's a country that's leading from the front there, but there's all this sort of machinery of taxonomy and credentialing that has to keep adapting even as the skills keep changing. I think that where we're going is entrepreneurial work for everyone, because everyone can build something now with these tools. You need to have these core human capabilities, but show what you can do as a sort of entrepreneurial thinker. And that work product is going to become more and more critical to how you get a job and how you succeed in a job. So degrees will still matter, your resume will still matter, alongside that skills will matter, but more and more I think the work product is going to be the thing that really punches through. So if you're looking for a job, you have to do the old ways still, but the more that you can showcase what you can do with these tools, and the story you have of your strengths, the better you're going to be.
Right. You did talk about India, and I do want to emphasize on the young Indian workforce, which is quite large in number. And while they're all very enthusiastic in looking forward to opportunities, they're also the most unemployed when it comes to white-collar jobs. Do we blame AI or do we just blame the geopolitical circumstances?
Look, it's tough to find a job. It's exceptionally tough if you're a fresher, if you're coming into the labor market in India. Our data shows that a lot of that is interest rates. If you look at sort of where hiring was pre-pandemic to now, and if you look at entry-level work with other work, generally it's interest rates. But I would say certainly the uncertainty of what AI is going to do to work is in the swirl. Companies are really wrestling through what is this technology? How are we going to use it? What does that mean for our workforce? People who are coming into the workforce are wondering what does this mean for the jobs that we need to get in order to build the experience that we need to have in order to become leaders at companies. I will say in the past, and I've been global now with this book, in the past few months, there's a really good conversation happening, which is that companies need entry-level workers. That is the future leadership. And those entry-level workers bring strengths. They know AI tools, they're more entrepreneurial. Entry-level workers, freshers, are starting to get more creative.
A warm welcome to all who are watching Business Today television, ladies and gentlemen. It's just the right time, almost the fag end of June, to take a health check of the world of mutual funds. The universe which creates market-beating and wealth-generating returns over decades has always been a happy hunting ground for quality stocks to be added to your portfolio, and of course the systematic investment plan which creates a huge amount of wealth if done rightly with the least amount of effort and the maximum amount of utility. Joining us on the show is Ms. Shweta Rajani, Head of Mutual Funds at Anand Rathi Wealth. A very warm welcome, Shweta. We'll be discussing the health of mutual funds at a time when probably the sentiment on the Dalal Street has improved for the better. The rupee is strengthening. FII selling seems to be ebbing, although it's not completely out of the woods. And of course, mid caps and small caps are throbbing with gains. How are you reading sentiment at this point of time on Dalal Street?
Good afternoon. Thank you for having me on the show. You know, what we are seeing is clearly a sentiment change taking place. And of course, I have to say that the domestic sentiment always has been on the positive or the stronger side. But even on the FII side, looks like, things may turn around very soon. That's the indication we are getting. Clearly, a lot of the negatives that were there now look like, behind you, higher crude prices, war situation, unclear, rupee depreciating. Looks like over the next 3-4 months, a lot of these could change. It's a combination. Some clarity emerging on, the war deal, the negotiations probably likely to close out, almost, on the verge of it. Then you have the crude price, which I would not be surprised if they could be below the pre-war levels over the next few months, given that we'll have a good amount of supply coming in, Iran oil, Venezuelan oil, all of that would start hitting the market. And plus with RBI measures on, FCNR, you could have FII flows coming in, a huge amount of flow, somewhere around 50 to 60 billion could hit the market on the debt side. Equity also, we could probably see it around soon. So all of that is clearly leading to a good amount of, building up on that positive sentiment which was already there.
Okay. Shweta, how are you looking at the inflows that are coming into mutual funds for the month of June? There was some issue in the May data where, of course, SIPs held to that 30,000 crore per month kind of a contribution, but many mutual fund holders gave up their patience and closed many portfolios. That itself was a market moving headline. What has been your gut feel about the data that you've seen for the month of June so far?
Yeah, so two data points. Our own, internal reading of the numbers is suggesting that for the first half of the June, numbers that we look at till 16th, 17th could be around a 22,000 of net flows in equity categories all put together, which means if I look at what it was May first half, it would have been somewhere around 11,000 to 12,000 crores net flows. So we are almost double of that in June for the first 15 odd days. Second is also the data that we see on cash deployment by fund managers. So there again, there's 40,000 crores which is invested by equity fund into equity market. So both of them are suggesting that June should definitely be a far better month than what we've seen in May. So May probably was just an aberration.
Okay, fair point. So, money flows resume, and how is that impacting the buying abilities of the mid cap and the small cap fund managers? What are you observing on that side?
So here, in fact, two, three data points that I would like to share is one, in terms of the category level flows that we are seeing. So mid and small caps continue to receive good amount of flows. I would not be surprised if they continue to be in those top three, four categories of fund flow, which they have been for the longest time period now. Second, especially mid caps have held very strongly in terms of profit growth the last entire year, followed by small
Yes.
caps. So both these segments have shown good fundamental reasons for why the flows should come in. Valuations are sitting attractive. In fact, in a few categories, we've also seen that funds have moved a little of their allocation from large cap to mid and small caps. So a little bit of that, overweight on mid small, even at a fund level, we are seeing that happening in some categories.
Okay. In terms of advice that we are getting to hear from the broader market, there is this view that many flexi cap funds, in fact, it's like saying that, my success story has now become my biggest millstone around the neck, which means that many of these funds, especially in the flexi cap category, have become so top heavy because of sustained SIPs coming in at a time when probably deployment opportunities haven't been much, and therefore their performance has become sluggish. Would you agree to that assessment? Does size impact returns?
So I don't, honestly agree to this, that size has a direct correlation with the returns, because we've seen enough and more cases where larger AUM funds have displayed and have consistently been in the top quartile. And I'm going to just take one example here. HDFC Flexi Cap has been among the largest funds in the Flexi Cap category. So you have Parag Parikh, and then it's followed by HDFC in the flexi cap category. But when the style of the fund manager played out, the value style of the fund manager played out, and if you look at this entire stretch of 2021 to almost 25 end, while you had that value playing out in the market, the fund continued to be in the top quartile. And even in 2021, it was a large size fund. Like, it continues to be the large size. It's receiving continuous flows. So yes, a smaller size does has its own advantage to the fund manager in terms of agility, and the kind of allocations that you can build in, the IPO allocations probably that you can build in smaller good companies. But not necessary. If you are large size, you'll be a bottom quartile fund.
Okay, so should we put this controversy to bed that the size of the AUM probably does not impact returns at all, as also the buy ticket of the net asset value? For instance, a very good performing mid cap fund is now in 4 digits. Many flexi cap funds are quoting at 1500, 1700, 1900 rupees as net asset values. Generally, investors get attracted to small ticket size. 12 rupee ka NAV of a flexi cap fund, they would rather want to put 1 lakh rupees there rather than maybe putting 1 lakh rupees in a fund whose net asset value is 1900 rupees. The fund has navigated many a bull market and a bear market with ease, but the ticket size gets in the way.
Yeah, I think I want to take a minute to explain this. Often people compare a mutual fund NAV with a stock price.
Yeah.
And then they feel, the stock is at a 52-week high or it's at a high level, which means it's overpriced or it's or high on value. And the same principle gets applied on mutual funds, but that should not be the case. You cannot compare a high price of a mutual fund and assume that you are entering into an expensive fund, or it could correct if it's sitting at its 52-week high NAV, because a mutual fund is a basket of different stocks. The stocks in the mutual fund basket also don't remain same. The fund manager keeps churning the underlying portfolio that he or she would be invested into. So it so works that, let's say a fund had 20 stocks in the portfolio, those stocks have done phenomenally well, so the NAV may have moved up from, let's say, 10 to 20. But even if the 20 price of the mutual fund is a high price, understand that the underlying 20 stocks don't remain the same. The fund manager would have booked profits from those companies and invested maybe in a new set of 10, 15, 20, 30 companies. So now the new underlying basket which is there still has the potential to keep growing. And that's where an NAV may touch from 20 to 2000 during the fund's life. But that 2000 rupees also doesn't mean it cannot grow from there on. And therefore, even if a fund is, as long as the fund is consistently performing, the fund manager has displayed good stock picking capability. One should not be worried about the NAV of the fund at which they are entering into, or during their lifetime in the fund. If the NAV is grown phenomenally well, it would still have the potential to keep growing.
Okay, perfect. So again, let me rephrase my question. Should we put this controversy to rest that the net asset value of a fund has absolutely no correlation to the return that it can offer?
Absolutely, yes.
So
even a 2000 rupees NAV would have the potential, if the fund manager is good, to further become a 4000 rupees NAV.
Okay. And ladies and gentlemen, suppose a 20 rupee NAV appreciates by 50% and goes to 30. That's the same return when a 2000 rupee NAV appreciates by 15% and goes to 3000. The market which underlines this rapidity or this J curve is the same, and mostly it is seen that those funds who have navigated many a bull and bear market are able to give better, higher quality returns rather than the smaller ones. Be that as it may, remember the size of the fund and its NAV have no correlation to the potential return. So for those advisors who are telling you कि सस्ता वाला फ्लेक्सी कैप फंड ले लो, सस्ता वाला मिड कैप फंड ले लो, सस्ता वाला स्मॉल कैप फंड ले लो क्योंकि इसकी एनएवी ज़्यादा है, ये जल्दी बढ़ेगी, that is far from truth. Now these two things have been explained very well by you, Shweta. Now tell us, based on the latest data, which fund looks good? Have there been any change in recommendations of the 14 that you advised for long-term capital building at Anand Rathi Wealth?
No, so given the funds that we've been recommending, we are very comfortable with those, and of course, we stick to the same recommendation. Also, Shailendraji, one thing I want to highlight is that even when you're investing in mutual funds, your review frequency should be maybe a little over 12 months. 12 to 15 months is where you should stay invested in a fund. Even if it's going through a temporary correction, it's fine. Good fund managers generally rebound within 6 to 8 months, and they continue with their upcycle unless there's fundamentally something going wrong with the AMC and the fund manager. So, that's one principle I think everybody should keep in mind when they are building their mutual fund portfolios.
Okay, fair point. Ma'am, it's unbelievable when you hear about people who want to hop between funds within 3 months, 6 months. Little do they realize that whatever little that you make in terms of return, you will be paying a short-term capital gains tax, and again getting into uncertainty with another fund. Be that as it may, these are the kind of things that make markets so interesting. Now tell us, of the 14 funds that Anand Rathi Wealth is recommending, top 4 small cap funds. I ask the same question again and again to you. That's because newer and newer people watch BTTV.
Sure. So, see, I'll probably say a combination of funds. Within the small cap category, you can go in for an Invesco small cap or HDFC small cap. If you want more small caps, then you can also go in for probably an SBI small cap, but it takes SIPs, not lump sums, and then you would have a Kotak small cap. Alternatively, you can also go in for a Kotak, multi-cap fund, which would still have a 25% at least small cap in the underlying portfolio, or go in for a Canara multi-cap. That again substitutes for having some small cap allocation in the portfolio. So you can go in for a combination of multi and small, or you can have a pure small cap fund in your portfolio.
Fair point. What catches your attention in the mid-cap space?
So mid-cap, again, we've been talking about the debate of size versus the performance, and I'm going to tell you 2 schemes which may be on the higher size, but again have displayed consistency in their performance. So here it would be a Kotak mid-cap or an HDFC mid-cap. Both are stuck to being true to label mid-cap funds irrespective of the size, and across cycles, they have displayed agility. They have had a good amount of churn in their portfolio, and even on terms of risk-adjusted return, they've been there.
Okay. Your favorites in the flexi cap category? I know all these answers, but I want them from you.
Absolutely. So, see, FlexiCap, is also being used as an substitute to the large cap, because most FlexiCap funds tend to have 60 to 70% of large cap in the portfolio. So I would combine both of them, and I would say there's an HDFC Flexi, and then there is a Quant large cap. So if you're looking at that large cap exposure through these categories, then you can go in for these funds.
Ma'am, what was the second one that you took the name after HDFC?
I mentioned about a Quant large cap, because both of them will have 80 to 90% of an underlying large cap exposure.
I'm so sorry I didn't catch the name.
I said Quant mutual funds, large cap fund. Quant
of course.
Cap.
Yes, of course. The gentleman was on show yesterday, and he was also talking about how he expects the market to do pretty well in the coming 6 months or so. Ma'am, there is often a question that we get on overseas diversification. You've answered this last time as well, and the issue becomes of feeling of missing out, because many of these funds that have a very good history over the last 6-8 months or so have stopped SIPs and have stopped lump sums because of the RBI cap. Now, what according to Anand Rathi should be the game plan or the psychology for investing overseas? Are some funds still open for subscription? Would you recommend them?
Sure. So, so 2-3 things here. One, I do understand recency bias playing out and investors thinking that they've missed out. So why not have some international diversification? But when you look at the data, and if I break it up into financial year wise, except for the last financial year, if you compare Indian mutual funds even after the rupee depreciation, so I'm comparing dollar return of international funds and dollar returns of domestic funds. The domestic funds outperformed the international funds. It's just the last financial year where international funds outperformed. So even being in the Indian markets, investors would not have missed out. And the way the markets are turning around, some of these international markets, Korea, Taiwan, US, seem to be overvalued there given the run up and a high probability of correction. Whereas you could have Indian markets which have not moved anywhere, and there the upcycle could hit in. So given all these situation that we are at right now, if as long as you don't have the requirement of maybe your child wanting to go abroad for further studies and you needing those dollars, you're not really missing out. Secondly, right, like you said, Shailendraji, that there are funds which have breached the limit and they're not taking lump sum. There are a few of them which may be taking SIPs. So you could have, maybe I think a Motilal fund. There is a Franklin US Opportunities which is still accepting SIPs of smaller amounts. I think 15 to 25,000 range. So if but they can shut any time that they think the limit is breached. But right now there are these 2 3 of them which are accepting in case somebody wants to allocate. But even if you've not allocated, data shows that over a longer time period you would have not missed out.
Shweta ji, what the issue is, you remember long time ago there used to be an ad that used to come on Doordarshan, iski kameez meri kameez se safed kaise. So how come my portfolio does not have an overseas fund which my neighbor's portfolio has? And the recency bias makes that a very difficult conversation to have with them. The Taiwan fund from Nippon actually rose 70% in one year. And how much grief I have had because of that, it's impossible to explain. Nevertheless, so, and between the time you came last and now, the Korean markets have corrected very sharply. So,
Yes.
this is buttressing your fact
Correct.
that don't get into the recency bias. Past performance, while it does dictate some future actions, necessarily does not mean that you hop into that and leave the Indian funds high and dry, whose time may have come.
True, because in most of these markets, it's not been a broad-based fundamental rally, right?
Yes.
You've in each of these markets, there've been specific stocks that were pulling it up, and especially driven by that entire AI play. So, theme of few stocks taking up the entire market up would clearly mean that even when the fall happens, it would be a sharp fall. So those are signs which say that you need to stay away from those markets unless it's a tactical call that you're taking, where you're going to enter and you're going to exit at the right time, which a normal investor would not be spending so much time studying that market and that company. So therefore, it's avoidable.
Right. The Korean markets, ladies and gentlemen, have corrected by 10% today. So, another 10% actually. Let me rephrase that word. Be that as it may, so that's the broader structure of how the month of June looks as far as mutual funds are concerned. And in less than 5-7 days or so, the funds would be giving in their changes in portfolio, changes in the AUM, and we'll have a complete picture for the month gone by. Are you observing any trends in buying and selling of equities, Shweta ji, within funds? Something that you may have gauged, sectors that they are going for, sectors that they are exiting?
So there haven't been drastic changes in terms of the sectoral allocations, but what we've seen is fund managers have probably reduced some allocation to banking and financial services, oil and gas, FMCG, a few sectors where there's been a minor correction in the or decrease in their allocations. On the other hand, you could have what I would call as telecom, healthcare, those sectors that have seen a minor improvement in the allocation. So that's the broader trend, but most of them are sticking around to these sectoral allocations that they have. Some change, what we noticed was clearly, at a category level may not be visible, but within those categories, some bigger schemes shifting from large to mid. I'll give you one example. In the large cap category, we've seen almost a good amount of portion going into mid and small caps.
Yes.
In fact, large and mid cap has also seen some amount of an small cap allocation building up in the portfolio. Over the last few months. So there we are seeing market cap changes more than the sectoral changes. But that could also be because June is when Amphi releases the new set of companies which qualify under large, mid, and small. So fund managers would be possibly
Nimble
getting aligned to the newer universe that would get officially released.
Right. This is exactly what a very senior chief investment officer who was on BTTV today in the morning said, that within their flexi cap category, they are moving more towards the mids and smalls, given the phenomenal Q4 numbers that came in and also the expectations of Q1. Okay. On that, we'll end it here, ma'am. What a pleasure. As always, we look forward to speaking to you again. Thank you for your time and such wonderful advice.
Thank you. My pleasure.
My pleasure. That, ladies and gentlemen, was Ms. Shweta Rajani, the head of Mutual Funds Advisory at Anand Rathi Wealth. Thank you for watching. We'll be back shortly.
नरेंद्र दामोदर दास मोदी ईश्वर की शपथ लेता हूं कि
In the 12 years as the Indian Prime Minister, Narendra Modi had to deal with 4 US presidencies under 3 presidents. 2 of them were Democrats, Barack Obama and Joe Biden, and twice with Republicans, while Donald Trump presided over the Oval Office. Narendra Modi was just sworn in as the Prime Minister of India in 2014 May. When Barack Obama, as the President of the United States of America, had roughly a year and a half left in his second term. In that brief period, they seemed to be working well. There were 2 landmark Modi-Obama summits held in that period. The first one was at the White House on 30th September 2014. And the second one happened when the US President came to attend the Indian Republic Day celebration as the chief guest in January 2015 in New Delhi. Together, they achieved a breakthrough on the long-stalled civil nuclear deal through an insurance risk pool and renewed a 10-year defense framework.
our 2 nations are prepared to step forward firmly to accept the responsibility of this global partnership for our 2 countries and for shaping the character of this century. The promise and potential of this relationship has never been in doubt. This is a natural global partnership.
Mirroring this warmth, President Obama concluded the joint briefing by declaring,
India and the United States are not just natural partners. I believe America can be India's best partner.
But a bilateral investment treaty and concrete climate emission caps remained unresolved between the 2 partners. Then came the first term of Republican President Donald Trump. This Trump-Modi era redefined the US-India relations through a mix of historic defense alignments and intense trade friction. The standard-bearer achievements, including the signing of foundational military pacts like Kamkasa and Becca, alongside a major $3 billion defense deal for Apache and MH-60R helicopters. Though the partnership was heavily anchored by personal camaraderie, famously captured during 2 massive joint rallies, Howdy Modi in Houston in September 2019,
My friend, a friend of India, our great American President, Mr. Donald Trump.
Followed by Namaste Trump rally in Ahmedabad next year.
The First Lady and I have just traveled 8,000 miles around the globe to deliver a message to every citizen across this nation. America loves India, America respects India, and America will always be faithful and loyal friends to the Indian people.
Mr. President, this morning in Houston, you can hear the heartbeat of this great partnership in this celebration of the world's two largest democracies.
But when it came to a comprehensive trade package, the two leaders could not come to an agreement. It remained unresolved after the US revoked India's GSP preferential trade status and sparred over tariffs. Post the first Modi-Trump era, US President Joe Biden and Indian Prime Minister Narendra Modi seemed to be working on a better business footing. In the 9 meetings spread across 4 years, together they finalized landmark agreements, solidifying a new semiconductor fabrication plant for national security and expanding defense ties under the ICT framework.
Toast to our partnership, to our people, to the possibilities that lie ahead, to two great friends, two great nations, and two great powers. Cheers.
आप बोलने में सॉफ्ट है, पर एक्शन में पूरी तरह स्ट्रांग है.
Yet critical differences between the nations remained unresolved. The leaders struggled to bridge divisions over India's continued purchase of Russian oil and navigated friction surrounding human rights and democratic values. From day one, the return of Donald Trump in the Oval Office for the second term has been a tumultuous journey in the relationship between the two countries. The era of MAGA plus MEGA has redefined geopolitics. Marking Donald Trump's second term and Narendra Modi's third, bilateral ties between the two have gone through periodic blow-hot and cold situations as trade, tariff and immigration remain main friction points between the two countries. The two leaders launched Trust, or transforming relationship utilizing strategic technology to secure critical mineral supply chains, and doubled bilateral trade targets to $500 billion by 2030. But tariff remained the bone of contention between the two throughout this period so far.
Who was a tougher negotiator today and who has a better negotiating tactic when it comes to tariffs?
Oh, he's a much tougher negotiator than me, and he's a much better negotiator than me. There's not even a contest. Okay?
The US imposed as high as 50% tariff on India imports by the last quarter of 2025. After strong negotiations and a few turns of negotiation tables, it has climbed down to 18%. Despite a framework agreement, a final comprehensive trade deal remains elusive due to disputes over H-1B visa restrictions and reciprocal tariffs. Bureau Report, India Today.
Hello and a very warm welcome on Business Today Television. Ladies and gentlemen, the markets are in fine shape. It's a 3-4 day rally which has added 1,000 points to the Nifty. We are well on our way to hit 200-day moving average in a couple of sessions, as also the banking and the financial space is doing immensely well. Now 3,300 points have been added in the previous 4 sessions on the Nifty Bank. Things are looking better for the mid-cap and the small-cap index as well. And the rupee, ladies and gentlemen, the star of the show, is appreciating versus the dollar. Oil prices have slumped below 200-day DMA. It is looking as good as it can be for equities. To discuss the way forward, we are now joined by Mr. Alok Singh. He is the Chief Investment Officer at Bank of India Mutual Fund. Mr. Singh oversees 22 open-ended funds, 2 closed-ended funds, and manages about 60,000 crore rupees in equity and debt. Namaste, Mr. Singh. A very warm welcome. How are you reading sentiment these days on Dalal Street?
Namaskar. See, the thing is, after last week news flow about some settlement emerging between US and Iran, there is a sigh of relief, and that is getting reflected in the way the markets have rebounded, or there is some amount of cheerfulness what we are seeing. While it is coming with a bit amount of caution, because the conduct of these two parties in last 3-4 months have not been very encouraging in terms of holding on to their words. So, while we have seen some rebound, there is some optimism, but we are not seeing, excessive amount of optimism right now. Maybe once they sign it on Friday and some time lapse, probably market will become more confident that yes, the peace which they are talking about is here to stay. And also then some amount of disruption which got caused because of this start getting unwinded over next 3-4 months. And I think that will then getting reflected into earnings margins. And I think, which is a positive sign, but I believe that the market is optimistically cautious, as they say right now.
I think we live with this caution, Mr. Singh. We've seen terrible times in the last 3 months, and many an equity investor has had his or her faith shaken in the Indian long-term story, although it remains intact in many parts. Because you also manage debt within BOI mutual fund, how are you looking at this government's steps to buttress the rupee, in particular the FCNR fixed deposit scheme that it has launched for NRIs and PIOs? You yourself represent a bank indirectly. How is the AMC and the broader bank looking at this scheme?
In our view, I think it's a very positive move, because yes, it has an implication on rupee per se, that the flows will help rupee stabilize. But having said that, if you look at with increased amount of Indian savers looking to invest in other financial instrument other than the deposit only, the banking system has been scrambling for getting deposit growth. And as you see, our lending growth has been higher than the deposit growth, and these concerns have been emerging often that, how will the bank sustain this kind of growth if the deposit does not catch up? So I think this also solves that purpose, because you get the liability raised from third-party sources outside India. And then I think that creates that equilibrium between lending growth and the deposit growth, which is very healthy for the economy in terms of the, especially at this growth phase where you don't want the credit growth to slow down. And the, the new fixed asset formation to slow down, because those are the building blocks for higher growth rate in coming times. So I think it's a good decision taken at the right time. It solves two purposes, not only the rupee but also the liability crunch which Indian banking system was facing.
Mm-hmm. Fair point. And it is for the government to address this anomaly. And you are very rightly pointing out, of course, money is coming into SIPs and mutual funds. That gladdens your heart, but it's coming at the cost of fixed deposits. That's very rightly put. And a balance has to be reached, because you can't have booming stock markets and banks out with a begging bowl. Be that as it may, Mr. Singh, what has the research team at BOI Mutual Fund concluded at the fag end of this conflict? What worked well for the AMC? What wasn't so good?
So if we look at from our point of view, and I suppose you are asking from our portfolio
yes.
Positioning, so basically, if you look at, we have been quite optimistic about few things like the lending financials. We were quite optimistic in financials, and the capital market names, we were quite positive. We were positive on auto as a consumption thing. We were positive on healthcare as a defensive play. We were not so positive on IT, and that's an underweight. Oil and gas has been an underweight for us. So far, those things worked for us. But as we say that, things are never permanent in nature. Now with the evolving situation, especially if this agreement actually gets signed, right, and some of the negatives get unwound, I think some of these things, maybe like oil and gas, may give a positive divergence over there. I think that could be looked at, but that is case to case. The team will work around it. But so far, these were the sectors where we had major sectors where we had overweight and underweight. So far, it has worked for us. Luckily, we didn't have sectoral allocation wise, we didn't have much of misses, so to say. But yes, it's a continuous job. We need to relook at things again.
Fair point. What are the opportunities that are in front of BOI Mutual Fund when it comes to the correction in valuations that we've seen? Nifty, of course, now well below the 10-year average in terms of PE and price to book. Are you actually looking at opportunities to deploy fresh money at this point, or what is the overall level of cash in the portfolio?
So currently our cash levels have come down. We would be on aggregate 3-4% of cash, which was far higher in the month of February. We were on aggregate having some 20% or thereabout kind of cash level, which we have invested, and it has helped us. So currently our cash levels are not that great. As you rightly pointed out, that with the earnings getting added, the markets on FY 27 and 28 basis, especially 28, are looking quite attractive because, whatever earnings disruption we may see in quarter 1 and quarter 2 may start getting normalizing in quarter 3, 4. And hopefully FY 28 will be a normalized year. And in that case, we may see, say on a BSC 500, we may see a 14-15% kind of earnings growth. That is quite possible. So I think overall the valuations are looking okay. And I would say they are fair. I would not say they are mouth-watering. They are fairly valued. But what has happened is that, because of the fact that we had a lot of disruptions coming from technology side, from the geopolitics side, some of the behavioral changes, the markets is increasingly becoming more bottoms up, right? So it is becoming very, very difficult to take broader sectoral calls, and I think that trend will continue for some time. So the focus is to identify individual stocks and build portfolios around that. That's how we are looking at right now. Increasingly, I think most of the market is fairly priced, so there is no larger pockets of undervaluations which you are seeing right now for us to plunge into something of that sort at a what you call top-down approach. So I think we believe that increasingly we are moving into a bottom-up thing, and that's where we would like to concentrate our energies on.
Ladies and gentlemen, this is as good a time as any to look at a fund that's managed by Mr. Singh. This is Bank of India Mid and Small Cap Equity and Debt Fund. It's just completed a decade of existence and has given a wonderful 16% CAGR each year since 2016. A lot of details will come in front of you. 45.33 is the net asset value, so 10 has become 45 in a span of about 10 odd years, and the returns are also fantastic. If you look at the 10,000 rupee SIP that you may have done in the direct route over a period of last 3 years, the returns have been to the extent of about 17% CAGR. So let's discuss this particular fund. Mr. Singh, what's the philosophy of marrying debt to mid and small? One would presume that mid and small cap funds would be used for wealth creation and creating multi-bagger returns, but you've added a talka of debt. What was the logic?
So the logic was very simple that, as you rightly pointed out, that mid and small cap, if invested well, help in wealth creation, and they are faster growth segments. Having said that, they are also married with a very large amount of volatility. And that volatility actually dissuade people to hold on for a longer period of time, or get out of these segments at the bottom of the cycle typically. So what we looking at this behavior 10 years back, we decided what if we can reduce some amount of volatility so that the holding period of people becomes longer, because they are not worried about the volatility as such. And then the compounding will do the magic. And I think that's what, if we look at 10 years back, we have been able to achieve, that the volatility has been quite lower. In fact, if the index which we follow for this is a 70% mid-small 400 and 30% CRISIL short-term index, the standard deviation of that index is actually lower than Nifty 100 index, right? So, we are able to have a lower volatility product with a propensity to deliver higher return, because you are majorly invested in mid and small cap over the medium to long term, provided you are able to hold on, and the debt portion allows you to bridge that gap. So I think that was the reason to cut the volatility and help people to have, because we have seen that many people avoid mid and small cap just because of volatility. So I think this solves that purpose, and I think that's where we thought of this.
Okay, and this has worked fabulously well for long-term wealth creators. If you look at the 7-year performance of this particular fund, the return is 20% CAGR, and Mr. Singh ranks second amongst 36 funds. A 5-year return is 17% CAGR. It's handsomely beaten the aggressive hybrid index. Again, ranked 4th out of 42. 3-year rank is 3rd. 1-year rank is 5th. 6-month rank is 1st. And 3-month rank is 2nd. Fabulous performance, Mr. Singh. And it is consistent whether you see short term 3 or 6 or whether you extend into the longer term 1, 3, 5 and 7. What is the philosophy when you look at stock picking? These are unusual stocks that are there in your portfolio.
The basic principle is that, since we have introduced debt and we are still a mid and small cap oriented fund, so anybody who is ready to invest in mid and small cap typically can question that, why should I take 20% debt and I not invest in mid and small cap 100% fund. Now, that means that, we need to have a portfolio which is 80%, on average it has been 75%, is able to do the heavy lifting for the balance 20%. So it's a bit of a barbell strategy over there, and that means that you have to have a bottoms-up approach over there, because you can't, do the heavy lifting only by beta. So basically, then you have to generate alpha, and for that you have to have, on the selection side, you need to have some bottoms-up stock picking, and that's where we have been concentrating, and that is what has helped us achieve the outperformance over the benchmark over almost 10 years now.
Okay, fair point. Let's look at the stock pickings that are there. Another point I'd like to ask Mr. Singh is, how do you ride the interest rate cycle vis-a-vis debt in this portfolio? Now that, cycle is mostly paused and you might see an interest rate hike, will the debt component change, or is it a constant 20%?
So, the debt typically while the debt allocation can be anything between 20 to 35%, and equity can be anything between 65 to 80%. But if I look at last 10-year average, roughly equity has been around 75% and debt has been around 20%. So we have, I think we will continue to manage that way. On the debt side, we are not looking to, take any aggressive either interest rate call or the credit call, so to say. Typically, we like to have a duration of around 2.5 years, because we are asking investors to invest in because it's a equity-oriented hybrid fund. So typically, you should invest for 3-5 years at least. So if my debt, if I run a 2.5 year duration on a roll down basis, most likely I will have a decent accrual based earnings from there. And the idea of debt is not that much of alpha generation, but more of the risk balancing, right? So I think that's where we try to do it with more of duration roll down and very little of, so to say, interest rate trading over there. So in that scenario, the rise in interest rates is not going to impact the fund too much. And nor we are looking to change our duration strategy substantially. Maybe we may reduce it a bit. We come more like 1.5, 2, but that's about it in case the rate starts moving up. But nothing substantial. It will remain accrual-based duration roll strategy.
Okay. In the last 10 years of the fund's existence, you must have played through 3 rate cycles, up, down, up, and now down again, and possibly up now. What has been the performance of the debt portfolio when rates have gone up?
See, in the short-term mark-to-market point of view, obviously, running 2.5 year duration, if the rates move up, you will have mark-to-market losses. You need to, there will be there. But since we are looking at, on a 3-5 year rolling return basis, in a fixed income with that kind of duration, you will accrue, whatever yield you have entered into, provided you continue to hold to maturity. And since most of the portfolio is hold to maturity, and as I said, the duration rolled down. So yes, on the intermediate basis, there can be some mark-to-market gain or loss both ways, depending on the rate cycle which you are. But yes, on 3-5 year basis, your contracted yield typically translate into your return. So on average, I think we have been able to have around 7 to 8% kind of return profile for our debt allocation.
Okay, fair point. We'll pause it here, Mr. Singh. What a pleasure listening to a very educative interview as far as mid cap, small cap and debt is concerned. This is an unusual fund, and it has done amazingly well for its long-term shareholders. Here's wishing you all the best, and we hope to chat again on many other parts of the market. Have a nice day, sir.
Thank you very much. Thank you for inviting.
That, ladies and gentlemen, was Mr. Alok Singh, CIO at Bank of India Asset Management Company. Thank you for watching.
These dramatic images from Bengaluru have become the center of a political storm. Three girl students who reached their NEET UG re-examination center minutes after the mandatory reporting deadline was seen climbing the college gate in a desperate attempt to make it inside, after being stopped at the gate. But despite scaling the outer gate, their efforts proved futile, ending their hopes to take the NEET exam. Parents blamed a Congress rally near the NEET exam center led by State Congress Chief Hari Prasad, and resultant traffic chaos for students failing to reach the centers.
नीट का एग्जाम आ गया, ये 1 महीना पहले अनाउंस हो गया था। हर पूरा इंडिया को, ऑल इंडिया सबको मालूम है कि आज 21 को नीट एग्जाम आ गया, मगर आज ये कांग्रेस की रैली रख गया है। तो कांग्रेस की रैली किधर? इधर ही है, पैलेस ग्राउंड पे। तो 3 आवर्स से इधर रोड ब्लॉक है, तो बच्चे कैसे आएंगे इधर?
BJP launched a sharp attack on the Congress government, accusing it of putting politics ahead of students, despite Rahul Gandhi shedding crocodile tears on NEET.
Yesterday's NEET examination date was announced much in advance. Congress should have been more sensitive in organizing this function, and they should have taken sufficient measures not to create traffic hassles.
Karnataka Minister Priyank Kharge, however, rejected the allegations. He said only 3 students had missed the examination. According to him, one candidate failed to reach on time after missing a bus, another arrived carrying an old admit card, while the reason for the third student's delay was still being verified.
We have issued traffic advisory, we have ensured that there is a dedicated helpline, and thousands of people wrote. Yes, even one person missing out is a bad thing. It's unfortunate. Now, can I be held responsible for a student who has not taken the right hall ticket? Can I be held responsible for one of the students who did not take the right bus from Magadi?
Congress has accused the BJP of manufacturing outrage for political gains.
Whatever it is, we are sympathetic. But if you want to play politics, we are ready for that also. First you apologize for the leaks. First you make the NTA chairperson resign. Then you make Dharmendra Pradhanji resign. Then you come and talk to me.
Meanwhile, the controversy has also drawn attention to Prime Minister Modi's decision on Sunday to delay his departure from Delhi airport by nearly 45 minutes to avoid traffic disruption for students appearing for the NEET re-examination. BJP ally JDS too hit out at DK's government.
Several area roads are blocked. In time, actually, those NEET students, they can't reach that place. All these things, because of Congress, all these things happened. Even though they know yesterday NEET exam is there, how this government treat our students.
Did students in Bengaluru fell prey to a mindset which puts politics above future of Indian youth? With Sagai Raj from Bengaluru, Bureau Report, India Today.
एक वाक्य म्हणालो होतो मी. तर आता एक नाही 6 टायगर इथं उपस्थित आहे.
Operation Tiger is no longer just political gossip. It is now a political reality. In a massive setback for Uddhav Thakere's Shiv Sena UBT, 6 of its 9 Lok Sabha MPs have crossed over to Eknath Shinde's Shiv Sena.
पुन्हा चौकार नाही, षटकार आता मारलेला आहे. 40 आमदार होते, 60 आमदार निवडून आले. आता गावी गेलो की पोटदुखी होते काही लोकांना इकडे, ठीक आहे. पण लोकांच्या जनतेच्या दरबारामध्ये देखील लोकांनी आम्हाला स्वीकारलं, पाठिंबा दिला.
Further escalating the battle over Balasaheb Thackeray's legacy, Shinde claimed that his faction is carrying forward the founder's original ideology. Shinde's son and Shiv Sena MP Shrikant Shinde also hit back at Uddhav Thackeray, saying leaders are considered loyal only till they remain with Uddhav.
लोगों को क्या करना चाहिए, खुद में क्या गलतियां हैं, क्या खामियां हैं, ये जब ढूंढोगे, इंट्रोस्पेक्शन करोगे, तो आपको उत्तर मिलेगा कि आपके सांसद, आपके विधायक आपको छोड़ के क्यों जा रहे हैं.
For Uddhav Thackeray, the timing could not be worse. The defection comes just days after the Mahayuti alliance swept the Maharashtra legislative.
This investment Guru tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said, well said, well said.
SEBI and NSE advise, consult only SEBI registered advisors and make payments only to verified accounts or UPI IDs. An investor awareness initiative by SEBI and NSE.
Presented by National Stock Exchange.
Good afternoon, dear viewers. You're watching the Business Today show with me, Sakshi Patra. This is where I get you all the closing action on Dalal Street. First up, let's take a look at what's hot in the corporate and the financial world. The momentum from yesterday's gains is now fading. The markets have turned sharply lower in the session today, slipping below the 24,900 level. The Sensex is also down by over 800 points, near 76,300 odd points. You're looking at the selling pressure in IT, metals, PSUs, banking names, as well as all the other sectors that are dragging lower, barring the pharma index. Bloodbath in South Korean equities can be seen. The Kospi has crashed over 9%, hitting a circuit breaker and halting the trade for 20 minutes. Heavy losses in SK Hynix and Samsung Electronics shares, coupled with massive foreign sell-off, is deepening the rout. Pharma stocks have surged in an otherwise weak sentiment on D Street. You're seeing the US FDA turning to Indian manufacturers to bridge a critical cancer drug shortage. Stocks like Cipla, Piramal Pharma, Laurus Labs have advanced on hopes of higher export demand from the US. India-US trade talks gather momentum in New Delhi. Commerce Minister Piyush Goyal and US Trade Representative Jamieson Greer are holding the discussions. Key issues include tariffs, rules of origin and investments, and also with the US Ambassador Sergio Gore saying both sides are working to finalize the trade deal. The West Bengal government's push to revive the Calcutta Stock Exchange has brought fresh momentum and optimism to one of Asia's oldest bourses. CSE officials have welcomed the move, saying it could create new opportunities for traders, investors and businesses. We'll straight away look at how the markets are trading at this point in time. Viewers, we're about 20 minutes away from the day's close, and now even below 23,850 odd mark, over a % cut for the Nifty today, 255 points gone. We're seeing sharp losses on the Sensex as well, barring just the pharma index. Rest all of the pockets are seeming to be trending lower. IT stocks have dragged a lot. Now you're seeing even the Nifty bank crack by over a %. In fact, IT stocks are down by over 2% in the session today, and investors are again looking at some losses on D Street emerge. Let me go across to our guest now. We have Gaurang Shah, Senior Vice President, Geojit Investments, to share with us a fresh take on the markets. Welcome to you, Gaurang, and good to have you with us as always. Well, what do you make of this screen that is turning red on the weekly expiry session? Investors have lost about 5 lakh crores in terms of the market cap cut in the markets today. What do you think is the key reason? Gaurang, I think you're on mute. We couldn't hear you.
Sorry about that, Sakshi. I hope my audio is clear now.
Absolutely.
Thank you so much for having me on your show, Sakshi. Good afternoon to you and to all your viewers. A small disclosure. All recommendations that I'll be sharing this afternoon on your show, they're part of our fundamental research team recommendation from a long-term point of view. Our company, Geojit, or myself, we don't have any kind of personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment interest. So I think the pressure that has escalated on the downside, and as we speak, I believe we are at the lowest point of the day, are the indicators that we are taking in from the Asian markets. Kospi almost circuit and then further pressure. And the kind of levels that we have broken, that has also put a little bit of pressure. I think it will be prudent to see either today or tomorrow to whether we are able to maintain 23,800, because that's the level where we have been able to bounce back a couple of times. So possibly we are somewhere near the bottom, but very difficult to say whether we can sustain the upside momentum. And 24,000, 24,200 on the higher side happens to be a big hurdle. So it's a range-bound trade. Sectorally, I think there have been pressure on IT as well. AI-led sell-off is also continuing. And certain sectors which were outperforming has also given up to this kind of selling pressure. So wait and watch. If we are able to maintain 23,800, then tomorrow, day after, I think we should see some kind of recovery.
Okay, let's straight away go across to the breaking news coming in with respect to the monsoon updates that we are getting. Monsoon has arrived in Mumbai. IMD has said that monsoon has covered Mumbai and more parts of Maharashtra. In fact, monsoon has covered the remaining parts of even Telangana, Odisha. Monsoon is to advance in Gujarat, in UP, in Madhya Pradesh in the next 2 to 3 days is what the IMD is pointing out. And very heavy rainfall alert has been coming in from the IMD for West Bengal, Sikkim. But there's also a heat wave alert at the same time for UP, Bihar and for MP at this point in time. I guess, Gaurang, you're the lucky one here to be receiving the monsoon showers, not us in the UP and Delhi region so far. What exactly are you looking at, at least with these showers now coming in, bringing some relief? Although there's an expectation of an El Nino, a super El Nino, but yes, whatever we have is being welcomed.
Yes, absolutely, Sakshi, and delayed, not to forget. Normally around first week of June, somewhere around 5th and 10th of June, Mumbai receives its shower, but this time around we had to wait for almost about 10 odd days or more than that to see the spell that we've seen. Yesterday we did see quite a bit of rain, but then during the day it all went off. And this morning actually started out with quite a decent amount of downpour. And as I speak to you, there is a trickle of rain which is continuing throughout the day. Let's hope and pray that rain gods are kind enough to us, though delayed. I hope the deficit mentioned by the SkyMet and the Met Department of long-term averages 90%. But more importantly, Sakshi, I think it is very important to have a distribution pattern. If the distribution pattern is good enough and if the rains reaches the crucial areas, then the 10% deficit will not play such a significant role. So it's initial stages, and I'm sure Indradev will shower his blessings on UP, Delhi, NCR region as well.
All right, hoping for the same, absolutely, Gaurang. But let's shift focus to the pharma story. This is something that we've been tracking on Business Today since morning, but India Today viewers must also know that a shortage of a critical cancer drug in the US could translate into a major opportunity for Indian pharmaceutical companies. Reports are indicating that the US FDA has reached out to Indian manufacturers for supplies of a drug which is used to treat multiple forms of cancer. Pharma stocks are already reacting to it. In an otherwise weak sentiment, we are looking at pharma stocks that are trading single high digits higher and even in double digits as well. Let me go across to my colleague Neetu Chandra Sharma to get us more details on the story. Neetu, first up, what exactly has happened? What is the critical drug in focus which is showing you a shortage worldwide? And, we are seeing pharma stocks in India react positively. Why do you think US FDA has reached out to India for this covering of this shortfall? What edge do we have worldwide?
Okay, so yes, actually the drug basically it's named as ifosfamide. It's a chemotherapy medicine used in treatment of various kinds of cancers, to name a few, which are testicular cancer, bladder cancer, and lung cancer. So the United States is currently facing a shortage of this drug following a technical disruption at a manufacturing facility linked to Baxter International. So along with the broader supply challenges as well. So as a result, the US is exploring alternative sources of supply. As we all know that India is known as the pharmacy of the world. So India is a very good alternative for the country. So Business Today spoke to officials and the Indian Drug Manufacturers Association, or IDMA, as you mentioned. So they told us that US government has written to the Indian government regarding this shortage, and the Indian government has subsequently reached out to IDMA to identify manufacturers that may be able to support these supplies. So Indian companies such as Cipla, Zydus, Alchem, Piramil, and all of these are among those in focus because of the experience in regulated markets and their manufacturing capabilities, Sakshi.
Okay, but Neetu, can this become a meaningful opportunity for Indian pharma companies, or is this only a short-term trigger just to cover the shortfall that's currently, being seen in the US?
So yes, actually, basically, currently this is the market sentiment and the development. However, it highlights the India's growing role in the global supply chain for critical medicines. As I said, that we are the generics pharmacy of the world. While currently, as of now, there is no confirmation yet of any specific orders of supply agreements. The industry experts have said that Indian manufacturers are very well placed to respond because of their large-scale manufacturing base and along with the long-standing presence in the regulated markets such as United States. So any commercial opportunity, however, will depend on factors such as product approvals, manufacturing capacity, and the ability to meet the US regulatory and quality standards. But for now, the focus is on whether Indian pharmaceutical companies can help address the shortage of an important cancer drug in the world's largest pharmaceutical market. So currently the scenario is such, but the situation is currently wait and watch.
Okay, thanks a lot, Neetu, for getting us those details. Gaurang, coming to you, how would you view this, with respect to the pharma space? We've discussed this entire space with you, for a long time. And now that we are looking at, once again, India being seen as the pharmacy of the world and SOS from US FDA now towards Indian manufacturers, clearly that this space is being seen as India can fulfill, the gaps wherever they exist. But like I asked Neetu as well, we need something that can be meaningful for Indian manufacturers globally. How would you look at that?
It's actually, so I think this drug in question for treating different kind of cancer, yes, we do have the capability and the capacity. And it was because of certain shortfalls that this particular deficit has arisen in US. I don't have the exact number in terms of the capacity that we have for this particular drug, but yes, at least for the short to medium term, unless and until the facility in US is back on track, it is going to be advantage. And not only for this, Sakshi, as you and your colleague were mentioning, India is, and India will remain pharmacy to the world. It is very difficult for any other country to come up with the kind of R&D, manufacturing capability, research and development, experience and knowledge and know-how. So it's going to be pretty long for the Indian pharma companies to, play a very vital role in terms of supplying to the world. But at the same time, the domestic market is also very, very robust. And incidentally, what is happening around the world, Sakshi, pharma, healthcare, defense, power, these some 3-4 sectors are relatively insulated from the external shocks that we are getting.
All right, defense, pharma, healthcare, these and power, these are the sectors that continue to remain resilient and better opportunities for investors to look at as well. Let's move on and get you an update from the Adani Group now, viewers. The group has now reiterated its plan to bid for all 11 government-run airports being leased to the private sector soon. Speaking at the inauguration of new commercial terminal at Mundra Airport, Jeet Adani has now revealed the capex in airports business that could touch 1 lakh crore rupees over the next 5 years. Let's listen to what he had to say.
प्राइवेट बिडिंग जब अभी नया 11 एयरपोर्ट का बिड निकल रहा है, वी विल बी सीरियसली पार्टिसिपेटिंग और ऐसा कोई टारगेट तो नहीं है कि 11 में से कितना लेंगे, लेकिन we significantly want to be an increasing part of the economy, of the aviation economy, तो growth continuously रहेगा.
So investment part next 3 years?
इन्वेस्टमेंट में हमारा जो 5-year इन्वेस्टमेंट प्लान था वो अक्रॉस ऑल एयरपोर्ट्स अबाउट 90,000 1 लाख करोड़ का इन्वेस्टमेंट प्लान है एंड दैट कंटिन्यूज टू बी द केस.
Sticking with the aviation story, Akasa Air is also all set to add several more international destinations to its route map over the next 2 years. The airline, which trails Indigo and Air India, both in size of the fleet and operations, it's now targeting an ambitious 30% increase in capacity this fiscal year. Let's listen in to what Akasa had to say.
The demand continues to remain strong, our revenue performance remains strong, our focus on cost remains strong, and our execution capabilities remain strong. So, could the world be different? I don't know, but we are very happy with where we are, we are very happy with the performance, and we are very happy as we look to the future that lies ahead of us.
Okay. What is your growth outlook for FY27 when it comes to Akasa?
We are likely to continue our growth trajectory. So we are likely to grow at about 30% on a Y-on-Y basis in terms of capacity. As we do this, we would continue to expect our unit revenues to continue to improve, and we would expect that our unit cost will continue to come down, and as a result of which we would expect that the profitability next year should be better than the profitability this year.
Great. In terms of fleet expansion, your plan has been quite on track, and in the coming years also you've maintained that you will be able to bring in the number of aircrafts that you have ordered. On the international front, do you wish to take a bigger leap, a bigger jump than what you have stated?
More than 25% that we have right now. So in the last 2 years, for us to add the capacity that we have added, it just shows the operational resilience that we have. Today, our international represents 25% of the total capacity. There is room for it to further increase. We started Phuket last year, which was the first foray into Southeast Asian market. We have announced Hanoi to start from September. Over time, as we get more capacity, we'll continue to add more and more destinations internationally as well. So our focus will remain both on the domestic and international markets. Over the next couple of years, you can expect that the international presence should be around 40% of the total capacity deployment, and that plan remains on track.
Okay, straight away going back to Gaurang then. Gaurang, how are you looking at this entire aviation space? Of course, within airlines, we just have one major monopoly play in the stock markets, that's Indigo. Akasa is not listed, Air India is not listed, but Adani Group is, of course, stepping on the pedal when it comes to expansion in the airport space. How are you looking at the opportunities there, and how would you play it as a market participant?
So again, candid disclosure, Sakshi, that we've been maintaining a positive stance on interglobe aviation, that is Indigo, for a pretty long period of time. Crude oil prices from $100, $110 plus have settled sub $80 a barrel Brent, somewhere close to about $75, $76 a barrel NYMEX. This is music to the ears for the aviation industry because the ATF, that is the aviation turbine fuel, happens to be the largest component in terms of input cost and expenses side. So that's positive. The government, under its scheme of Udan 1 and Udan 2, have managed to open up multiple airports targeting regional connectivity. And this is going to open up, again, a lot of opportunity, not only for companies which are handling these airports, but along with that for the aviation company as well in terms of newer routes opening, newer capacities coming up. And if I'm not mistaken, I was reading a report, Akasa Air has already inducted two or three new Boeing 737-8 MAX aircrafts, and they are further going to add it, including Indigo, that is in the interglobe aviation, have also inducted a lot of new aircrafts, and a lot new are in the pipeline to add, specifically targeting the expanding domestic market as well as international markets. So yes, and we believe that Pravas Bharati, medical tourism, and along with that, leisure and business travel is going to go at a much higher level. By the virtue of that, Sakshi, income for both airport operating companies and airline companies seems to be on the track. But there are certain concerns in terms of expenses side. Whenever, there is a good old saying, Sakshi, in the aviation industry, that airlines make money when the aircraft is in the air. Airlines drain money when the aircraft is on the ground. So as long as your aircraft stays in the air, you're making money.
Absolutely. 5 minutes to go before we shut off for the day. The markets have slipped below 23,800, but it's time to take some questions of our viewers with Gaurang right now. Gaurang, our first question from our viewer is from Lucknow. Shivam Pandey has asked you this question. He asks you, is this the right time to invest in agri stocks for the long term? How would you advise him?
Well, so I don't recollect specifically, but agri-related companies we did have coverage on LT Foods, and now of course this Middle East situation had actually created a negative overhang on agri-related stocks. So at one point of time, I'm not giving any recommendation over here, but just mentioning that LT Foods. Then you have companies like Avanti Feeds, again, which are into aquaculture, of course, not directly into agri. But and one more thing, Sakshi, we were discussing about deficit rainfall at the beginning of the program. For India, it is again very, very crucial to have a decent amount of rainfall because large part of our population depends upon agri activity, and you have to feed a large population as well. So this is a little bit of sticky time. I won't give any specific stock recommendations as I don't recollect, but LD Foods used to be under our coverage.
Okay. We have the next question from Arpit Shah from Bharuch. Says, are IT and pharma stocks still safe bets for investors? How would you address this?
There is nothing safe in stock market. Everything is exposed to risk. Risk can be locally as well as globally. But as an investment theme, Geojit investments remain positive on both IT as well as pharma. Having said that, IT, you need to have 1.5, 2 year plus kind of time horizon, and you need to put your companies which you decide to invest in IT under the microscope and get invested, because the ever-changing challenge in terms of new technologies, new platforms and new tools coming in. Pharma, as we discussed earlier, remains to be in the sweet spot.
Okay. Aparna Pawar from Pune, apologies, says that I am facing losses in metal stocks. What should I do? Should I hold or exit right now? How would you address that?
Well, the question is half, because we don't have an idea whether she's a long-term investor or a short-term investor.
Yeah.
So actually, as a theme, we remain positive on metals, both sides, ferrous as well as non-ferrous. Some aspect of metals did correct a little bit, specifically targeted to aluminium and copper and zinc related companies because of the so-called resolution in the Middle East with respect to war and the so-called peace deal, according to Mr. Trump, being digitally and virtually signed. But again, that's very, very fragile. Overall, we remain positive on Hindalco, Vedanta, Hindustan Zinc, Nalco, Tata Steel and JSW Steel. I hope she's a long-term investor.
Okay, those are the questions that we had from our viewers. But there's another breaking news coming in, viewers. The global tech meltdown is deepening. We're seeing the Nasdaq futures sink 1,000 points now. D Street, of course, is sensing the same sentiment. We have drifted to the low point of the day at 23,790. But when we look at the Nifty IT index, that's dropped by 2.5%. Sensex has cracked nearly 1,000 points as well. And all of this also has to do with what's happening globally into the markets. Gaurang, I'll try to come and understand this. Why do you think this is happening? Is there some kind of a link? What's happening with these massive big bang IPOs that are coming globally? We've seen what happened with SpaceX. It's crashed substantially. We are seeing what has happened with Kospi. There was a trading halt of 20 minutes and a 9% fall on that one. The tech and chip makers were the ones that really caused that sharp fall on the index there. So what's truly happening? Is there some kind of a link that when these big bang mega IPOs come, which drift billions of dollars, does that lead to the stock markets worldwide, secondary markets to crash? And is that the reason why the D Street is also looking at this fall?
So it is all to do with hype, Sakshi. The kind of hype that was created with SpaceX, the kind of hype which was and which is created with respect to AI. I was reading a report that the South Korean markets, there are a couple of AI related companies. There's been a huge series of resignation from top management level. I don't know much about it. I don't have any certified document to prove that, but these are some reports that I read. Along with that, we saw what happened with Accenture and Cognizant in the US. There was downgrade that happened, and as a resultant of that, we saw pressure across the globe for IT companies, including India. I think it was just a couple of days back, then the Indian IT index was down 4 to 5%, and some stock-specific companies were down close to about 7 to 8%. But let me say this over here. We have made a very humble beginning with respect to AI. We have not gone all out. IT companies in South Korea, in Japan, in China, in US have gone in all out. And now they are possibly thinking whether that was a wise decision or not. So we will have this kind of shake-up with respect to IT sector and news flows with respect to AI, new tools, new platforms, which will create positive and more of negative reaction. But as a theme, like I mentioned earlier, Sakshi, we remain positive on the Indian IT companies across mid-cap, small-cap and large-cap as well, with a caveat, 1.5, 2 year plus kind of time horizon, and don't expect the returns that IT sector gave you 5, 10 years or more back.
Okay, fair point. Viewers, we look at the markets close now, 23,824. The final print on the Nifty, 278 points lower. All the sectors barring pharma end lower in the session. Metals cracked 3%, IT down by 2.2%, PSU banks also down by nearly 2%. You can even see the broader markets lose about 0.5% in the session. Pharma index, although managed a near 1% up move in an otherwise weak sentiment. India VIX has sharply moved up, nearly 11% higher at 14.2. Again, looking at the kind of fear that's trickling into the markets. Let's look at the big Nifty losers in the session today. We have many laggards coming in from IT, metals and PSU banks forming the big bang losers for the Nifty. Infosys, TCS, Adani Enterprises, upwards of 3% cuts there today. We're also looking at Wipro, JSW Steel, Tata Steel as some of the other laggards. On the winning trend, you'll find some pharma names there that have managed to buck the trend in an otherwise weak sentiment. Cipla, Dr. Reddy is among the top movers, but the quantum of gains is also low. Power Grid is up by about 0.7%. Axis Bank, Sun Pharma, Apollo Hospitals as some of the names that have also pulled up. But that's how the markets have shut shop. Viewers, in case you too have any questions about your investments in stock markets, mutual funds, SIPs, gold-related questions, then you can definitely send us your queries on the number that's flashing on your screens. And now we share with you a fresh update when it comes to the Calcutta Stock Exchange. Once India's second largest bourse and a key pillar of the country's financial markets, it may be set for a revival after more than decades of inactivity. The West Bengal government has announced plans to support the historic institution, raising hopes of a fresh start for the 118-year-old exchange. What does this revival plan mean? And can the CSE reclaim its place as India's financial ecosystem? Our correspondent, Anirban Sinha Roy, visited the exchange in Kolkata to find out. Let's go across to find out that ground report.
The Calcutta Stock Exchange, once the financial symbol of Kolkata and West Bengal's economy, is going to revive again, as what we have heard by the West Bengal government, the newly elected West Bengal government led by Bharatiya Janata Party, Shubhendru Adhikari and Finance Minister, as well as what we have learned from the budget session itself, because this is the first budget session by the BJP-led West Bengal government, the double engine, where Finance Minister Swapan Dasgupta has assured that the Calcutta Stock Exchange, once a proud institution, will be given a priority. And right now we are standing just in front of the Calcutta Stock Exchange building. As what we have learned is the government wants to help bring the 118-year-old institution back to life as part of its vision for a Viksit Bharat and the Viksit Bengal.
All right, viewers, as we wrap up this edition of Market Closing, do not forget to get your hands on the latest edition of the Business Today magazine. This edition brings sharp analysis on one of India's biggest economic vulnerabilities, our growing import dependence, and why the country's policy response needs to become smarter and more strategic. The real lesson from the ongoing West Asia crisis lies in just how exposed India, the world's most populous nation, is to the external shocks, to supply disruptions, geopolitical uncertainties. This issue goes on to examine the sectors where India remains dependent, the risks that come with it, and the policy choices needed to build greater resilience. Grab your copy of the latest edition of the Business Today magazine and explore the stories that matter the most to India's economic future.
Presented by National Stock Exchange.
Look, this investment guru's tips will double your money. Just claim the offer.
Double your money from any random group. Pay attention. Promising double returns, they'll lure you in tight. Unverified groups will send fake tips overnight, emptying your pockets before you can fight.
Well said! Well said! Well said!
SEBI and NSE advise consult only SEBI registered advisors and make payments only to verified accounts or UPI IDs. An investor awareness initiative by SEBI and NSE.
A tragic afternoon in Lucknow. A massive fire breaks out in a commercial complex in Aliganj, housing a gaming zone, a coaching center, and a pet store. Turning an ordinary day into a scene of chaos, panic, and irreversible loss. In minutes, smoke engulfed the building, followed by screams and a desperate struggle for survival. Several lives have been lost in the heartbreaking tragedy, most of them young students. The images difficult to watch and even harder to forget. In a desperate attempt to survive, a student was seen jumping from the building.